The stock market's down. What do you do when that happens? Should you do a Roth conversion? That's what we're going to be answering today. I'm Elliot Apple, founder and financial planner of Kindness Financial Planning, and today we're talking all about Roth conversions when the stock market is down. But before we do that, let's talk about what a Roth conversion is, and then we'll talk more about what are the benefits if you do it while the stock market's in a decline. So with a Roth conversion, the idea here is that you're voluntarily paying money on IRA distributions to move them to the Roth. So you're going to take IRA money or pre-tax money and do a Roth conversion to get that going into a Roth tax-free. And you're essentially telling the government, hey, I'm willing to voluntarily pay tax on that today at whatever rate it is to take money out of that IRA that's going to be taxed as ordinary income. When you do this, you can pay the tax with outside investment assets, which is often the best case scenario, or you can actually withhold money doing the Roth conversion and actually have taxes withheld for that. It's really up to you, but generally if you have the tax to pay it outside, that's generally the highest and best use of those funds. What you'll end up receiving is a 1099-R from the custodian showing that you did the Roth conversion, and you'll use that for your tax return. Although some people choose to move cash, sometimes a better use of that is actually using investments. So investment ABC is in your IRA and moving that directly to the Roth and paying tax outside of that for the Roth conversion. You ultimately can use cash if you want to, but oftentimes it's simpler and easier if you just move investment A from this account to the Roth IRA. Let's spend a few moments talking about the benefits of a Roth conversion and why you might want to do that. This isn't going to be comprehensive by any measure, but I just want to bring up why you might want to do it. The number one reason is that you expect your future tax rate to be higher compared to where you are today. And before you think, hey, I'm going to be in a lower tax rate for the rest of my life, wait, pause for a second. A lot of people who have required minimum distributions, full Social Security, later in life severely underestimate what rate of tax they might be paying. I've met a lot of people with large IRA balances who aren't thinking about the tax that they'll pay as the government starts to force money out of that account. I've seen people who are taking distributions of hundreds of thousands of dollars out of their IRA because they did such a great job saving their IRA. So if you're sitting here today and you think, hey, I have a pretty large IRA balance, or I may one day because I already have quite a bit of money in an IRA, you might want to start thinking about a Roth conversion and start thinking about, hey, is the tax rate that I'm in today, do I expect to be in a higher one later? And that could mean just higher levels of income. That might mean tax rates going up. So a lot of people who are thinking about Roth conversions, they want to hedge their future tax rates, either because their income might go up or they expect tax rates to be higher in the future. As an example, let's say that you retire early, and this is often a prime example of when you might want to consider a Roth conversion is you haven't started Social Security yet, you might be living off brokerage assets, you're not forced to take money out of the IRA, and maybe you're delaying Social Security for as long as possible. In that scenario, you have a very low level of income. Maybe you're in the 10% tax bracket, just as an example there. And you run a tax projection over your lifetime and you think, I might be in the 25% tax bracket later. It might make sense in that situation to voluntarily pay tax at a rate of 10 or 12%, maybe even 22%, to avoid or reduce the amount of income that is being taxed at 25% later on. Another situation to keep in mind is that for those who are married, oftentimes there is a widow or a widower penalty that if you have similar levels of income and you go from a married filing jointly bracket that has pretty wide brackets, going down to a single bracket, you sort of compress that income, but if you have similar income, that can actually push you into a higher bracket. I've seen situations where someone might be in the 24% tax bracket, but given the IRA balances that they inherited, plus Social Security that they have and maybe they have pension incomes, that actually bumps them up to the 32% tax bracket. So there's plenty to be done here, particularly if there's differences in ages and that you expect one spouse to pass away earlier. It might make sense to do a larger Roth conversion. This isn't advice. You need to run a tax projection over your lifetime to figure out what that might look like and whether it makes sense to do a Roth conversion at all. I want to be upfront that doing a Roth conversion during a market decline is not a form of market timing. I'm not advocating for that. I'm saying that if you already plan to do a Roth conversion in the current year, you just happen to find yourself in a time period where the stock market is down, when you come to that conclusion, it can be an opportune time to do that. And what I mean by that is, let's say that you just finished your tax return and it's March or April, and then you decide, hey, last year I should have done a Roth conversion, or I did and it worked out well, I want to do another this year, and I have a pretty good idea of what my income is going to be so I can do that projection, but the market just went down 10 or 20%, you might take advantage of that by saying, hey, the market's down, I'm going to get things on sale to be able to do this conversion. That can be great. I'm not saying wait throughout the year for the market to decline, because we don't know if that's actually going to happen. We also don't know when it's going to happen. We're not trying to market time at the exact bottom here with it. I'm just saying that during a market decline, it can be an opportune time if you're already going to do the Roth conversion. The other thing worth mentioning is you could sort of dollar cost average into the Roth conversion. So if you're unsure of your income, or you just don't feel comfortable converting the full amount of the Roth conversion, you could do a portion now and a portion later in the year, and then another portion later on, or split into two. There's lots of different ways to do that. My main point being, similar to stocks, some people aren't comfortable investing the full amount if they had a lump sum at once. You could step into the market over time. Personally, history shows that historically you're better off just doing that lump sum investing or the lump sum Roth conversion, because more often than not, stock markets tend to go up, so it's better to get that money growing tax-free sooner. Let's go through an example just to highlight what the benefit is of doing a Roth conversion during a decline. Let's say you do your analysis and you decide, I'm going to convert $100,000 this year from my IRA to my Roth, voluntarily pay tax on that, and I'm just not quite sure when to do it. But let's say I've reached this conclusion and the stock market just went down 20%. And I have an investment in my IRA, it's worth $100 a share. So I was planning on moving 1,000 shares of that investment to the Roth. But when I go to do it, the market is magically down the next day 20%. And I decide, okay, I'm going to still do the $100,000 Roth conversion, but instead of moving 1,000 shares, for that same $100,000, I can actually move 1,250 shares of that. And that's because the market's down 20%. So I move the 1,250 shares to the Roth IRA, and then let's say, just magically to make this work very easily, the market goes up the next day, and that it's no longer at $80 a share, it's at $100 per share. So that $100,000 that I moved, or that 1,250 shares, is now worth $125,000. All of that growth was now tax-free in that situation. So I was able to convert at a low point, and as the market recovered, I got all that money growing tax-free in the Roth IRA. That is the beauty of doing a Roth conversion when the stock market is down, is you're getting things on sale, and assuming the stock market recovers, you'll get all that growth in the tax-free account. This was a popular strategy back in the COVID times in March of 2020, when the market went down really quickly, about 30%. I know during that time, a lot of people did Roth conversions. And at that time, we had one of the shortest recoveries on record, which meant all that growth during that year was tax-free when we did these Roth conversions. So that just shows you the power of what can happen. The other day when Trump was announcing tariffs and then walking back tariffs, and you had really big moves in the market, there were situations where people did a Roth conversion on the days that it was down. And then when stocks popped the next day, 7-10%, all that growth was then tax-free in the Roth IRA. That just shows you the power of, if you can get lucky timing it, or you happen to make the decision that you're going to do a Roth conversion and the market is down during that time period, it can work in your favor. Again, I want to stress that I'm not advocating for market timing. This is a strategy, a year-by-year analysis that you want to do to make sure you want to do the Roth conversion. And if you happen to be in a time period where the stock market is down, and you know what your income is going to look like that year, it can be beneficial to do the Roth conversion during that period of time, and even consider converting a little bit more because the market has declined. If you found something in this video helpful, please click that subscribe button and like this video so other people can find out about it as well. Thanks for watching.